The word recession is everywhere right now, on the news, on your social feeds, in every financial headline you read. Economists are pointing to inverted yield curves, rising unemployment, shrinking consumer spending, and a slowdown in manufacturing. Stop. When you see those warnings and your portfolio drops 20, maybe 30%, every instinct in your body screams at you to sell everything. But giving into that fear permanently destroys your wealth. Instead of panicking, we are going to build a defense. Today, I'm giving you a strict 4-step action plan to crash-proof your money so you don't lose a dime to fear when the market drops. Step 1 begins completely outside the stock market. You need to calculate exactly what it costs you to live for 3 to 6 months, just the bare minimum: rent, groceries, and utilities. Take that specific amount of cash and move it directly into a high-yield savings account. Then prioritize paying down any high-interest debt, like credit cards. This liquid reserve functions as a protective shield for your long-term wealth. Recessions often bring layoffs, and this cash ensures you can survive if your primary income disappears. Without this shield, a sudden job loss forces you to sell your investments to pay rent, exactly when the market is at its lowest point. With a fully funded emergency reserve, you mathematically eliminate the pressure to ever sell your stocks during a personal financial crisis. Step 2 is removing unnecessary risk. Cash you need in the next 1 to 3 years should not be in the stock market at all. For your long-term money, holding single stocks is incredibly dangerous right now. Individual companies can go to zero, and during a recession, many do. The ultimate de-risked asset is a broad index fund, like one tracking the S&P 500. It spreads your money across 500 of the largest U.S. companies. It has never gone to zero. History proves how resilient this strategy is. If we look back to 1950, investors faced the massive global uncertainty of the Korean War. Later, they faced the extreme anxiety of the 2000 dot-com crash, where the S&P 500 dropped 49%. This chart shows $1 invested in the broad market in 1950, growing into over $1,000 today. Even terrifying drops like the 57% plunge in 2008 or the 2020 COVID crash recovered rapidly to new all-time highs. Trying to outsmart the market fails. Staying invested in broad indexes wins every single time. Step 3 is automating your wealth engine. Log into your brokerage account and set up an automatic recurring monthly investment. When the market drops, you will be deeply tempted to pause these contributions to wait and see where the bottom is. Do not touch them. Look at this comparison chart. If you tried to time the market and missed just the 10 best trading days over the last 20 years, your overall returns would literally be cut in half. This line graph illustrates dollar cost averaging. By investing a fixed amount every single month, you keep buying at regular intervals as the market dips. And when prices drop significantly, your fixed monthly contribution automatically scoops up more shares at a steep discount. Automating your purchases completely removes human emotion from the equation, turning a scary market crash into a guaranteed wealth-building opportunity. Step 4 is the hardest directive to actually follow, the do-nothing protocol. Log out of your brokerage accounts and turn off the financial news. The stock market is forward-looking. It starts falling before a recession officially begins, and it starts recovering long before the economy actually feels safe again. Let's say you invest $10,000. The market crashes 30%, and your balance drops to $7,000. This branching path diagram shows what happens next. If you panic and sell on path A, you lock in a $3,000 loss. But if you stay invested on path B, you ride the recovery back to $10,000, $12,000, then $15,000. If checking your balance is driving you to panic, remove the temptation entirely. Delete the investing app from your phone. A temporary drop in your portfolio's value is not a realized loss. It only becomes a loss if you physically press the sell button. You now have your defense in place: a funded cash shield, a broadly diversified index portfolio, an automated wealth engine, and strict rules to ignore the noise. Recessions are scary, but they are short. The average recession lasts just 10 months, and every single one in American history has ended. Your job as an investor is never to predict recessions. Your job is to be structurally prepared for them, stay the course, and build your wealth. If this video gave you clarity, hit like and subscribe. Drop a comment below. What is your specific recession strategy for 2026? I read every single one.